and gentlemen. Today I'm going to present about my research, capital structure, and firm's value, the case of final tax regulation on Indonesian construction firm. So first, the research background. So the most widely accepted objective of a firm is to maximize their shareholders' wealth. Through the firm managers can utilize the financial management concept in order to do that. The this concept recognizes three main decisions that is included in the financial management concept, which are the investing, financing, and dividend decision. Today we're going to focus more about the financing decision. So, financing decision is the decision regarding how a firm finances its operation and growth. It is a question on whether to use more debt or more equity to finance a firm. To use more debt means the firm issues more bank loans and bonds, while to use more equity means the firm issues more stocks. This proportion of debt and equity that firms utilize is known as the capital structure. So the cost of financing from both debt and equity that is incurred to a firm is known as the cost of capital. The financing decision is done mainly to minimize the cost of capital. Capital structure theory suggests that by minimizing the cost of capital, firm's value could be maximized. Therefore, generally, by managing capital structure to financing decision, firms can decrease their cost of capital and increase firm's value. So, pecking order theory suggests that there is a hierarchy of financing sources that firm managers prefer based on the cost of capital. Now, these three sources of financing are internal financing through uh, earnings that are retained by the firm, debt financing, and equity financing. Please note that the debt financing is considered to be more beneficial due to the tax shielding effect that debt interest has on how the income tax is calculated. So the Modigliani and Miller theorized in 1958 that in a world without taxes or in the assumption of a perfect capital market that has no tax benefit, no bankruptcy cost, and no asymmetric information, capital structure is irrelevant to firms' value because the cost of equity moves equal to the cost of debt. However, they were heavily criticized for their unrealistic assumption, mainly the no tax benefit assumption. So in 1963, they developed and revised their theory to include taxes, where they theorized that in a world with taxes, the cost of capital can be decreased through the usage of debt due to the tax shielding effect that debt's interest gain. Therefore, debt financing has a clear advantage. So managing capital structure is advantageous to a firm. But what if there is a situation where the firm's debt interest does not gain a significant benefit from tax shields, similar to the M&M 1958 theory assumption? This is where the final income tax come in. The final income tax is a tax concept implemented since 2008 in Indonesia, which directly calculate the final income tax rate to the firm's revenue, as seen by the uh, figure of the firm's financial statement. The final tax calculation is calculated directly to the sales revenue, whereas the conventional income tax, labeled the non-final tax, is calculated by multiplying the income tax rate to the earning before tax. In this way, the final tax does not consider the expenses needed to gain that sales revenue, including the interest expense. Therefore, when a firm gains revenue from the that is included in the final tax object, the firm does not gain that tax shield from their interest expense. So the finance minister uh, declares in 2009 that certified construction business has a 3% final tax rate, where in 2010 the Indonesian government regulation stated that tax benefit of a firm is calculated in proportion of a firm's non-final to final tax revenue. Next, so what is the implication towards the construction firm? As we can see, the construction firms relies heavily on the final tax benefit that they gain. More uh, com- uh, they realize to file tax more towards their non-file tax. So, final tax does not consider tax shielding expenses. Therefore, firms that rely heavily on final tax revenue would gain little tax shield on its debt. So, is the capital structure still relevant? Now, as we can see that firms, the construction firms, the top five construction firm in Indonesia still manages their capital structure as seen by the similar pattern of capital structure management within some of these firms. So the statement is construction industry is the backbone of Indonesia's developing infrastructure. As such, the firm's sustainability is important. Problems are final tax law decreases firms' tax shield. M&M suggests that without the debt tax shield, firms' capital structure is irrelevant. Next, the construction firm still manages their capital structure. In the hopes of maximizing shareholders' wealth, does construction firm really need to consider their capital structure? So the question is, does capital structure have a direct effect on firm value? To test this, and whether the cost of capital still mediates the effect of capital structure on firm value. The scope and limitation is the construction firm listed in Indonesian Stock Exchange that is publicly listed between 2012 and 2019. The theoretical foundation of this research are as such, capital structure mediated by the cost of capital to the firm's value and its direct effect between capital structure towards firm value. The hypothesis is the capital structure and firm value has a significant effect, while past theories suggest that positive or negative effect is inconsistent. We hypothesize that it has a significant effect, whereas the mediated effect is hypothesized to have an insignificant effect based on the 1958 Modigliani and Miller propositions. The hypothesis is as such. Next, the sampling technique that is used in this research is purposive sampling with characteristics as such. Out of the 20 firms in the population, 5 firms were able to be observed as the samples. In total, there are 35 data points for each variable from these 5 firms. So the data collection method is secondary data from annual report and internet finance database, whereas the operation variables is as such with long-term debt to equity ratio as the independent variable, weighted average cost of capital as the mediating variable, and stock price as the dependent variable. Please note that the stock price is lagged behind the other variables to consider any delayed effect. So we use the annual closing adjusted stock price from each year, and the tax rate will be calculated in proportion to the non-final income of firms as per the 2010 final tax regulation, which dictates about the tax benefit. And the statistical model is as such. We use the simple mediation model that is developed using the linear regression technique by Andrew Hayes. This is the model. This is the independent variable. Is the mediating variable, the same as the theoretical framework. Next, the data analysis. As we can see, the long-term debt and equity ratio or the capital structure has a positive effect towards stock price, while their effect shows that it has a significant p-value. Therefore, the direct effect between the variable is significant. Next is the indirect effect through the weighted average cost of capital. From the bootstrapping, we can see that it has a zero between these two values, which means that the indirect effect is insignificant. Therefore, the first hypothesis is accepted, which stated that there is a very positive significant effect between long-term debt equity ratio and stock price. While the mediating the second hypothesis, which is about the cost of mediation of the cost of capital, is also accepted because it has insignificant mediating effect as hypothesized. So as hypothesized, the final tax decreases the tax shield. Therefore, the cost of capital no longer mediate the effect of capital structure towards firm value. Therefore, the but the analysis shows that there is still a direct positive significant effect between the capital structure and firm value. Therefore, the capital structure of a firm should still be managed despite the final tax implication. Furthermore, an only direct effect could signal other mediating variable that is not utilized in this research. Possible explanation of this effect can be explored using the financial management decision concept that we have discussed in the first chapter. So the conclusion is the capital structure remains relevant to manage despite the final tax implication on Indonesian construction firm. However, this research indicates that the capital structure could no longer affect firm's value through the cost of capital. So we recommend that Indonesian construction firm managers should continue to manage their capital structure. Firm managers should utilize a higher debt debt financing ratio as a source of capital as it has positive effect on firm's value. Uh, Furthermore, calculation of the optimal capital structure for construction firm in Indonesia should no longer utilize the cost of capital concept as it no longer have a significant mediating effect. Therefore, we recommend further study utilizing investment decision and dividend decision uh, from the financial management concept as mediating variable to explain the effect between capital structure and firm value. Thank you.